Welcome to the session on budgetary receipts from the unit Government Budget. I'm Tejinder Khosla and I've been teaching economics for more than 30 years. I was heading the economics department in a leading institution in Delhi NCR. In this session, we'll first discuss the definition and structure of the budget briefly. Then we'll move on to revenue receipts and its components with examples, capital receipts and its components with examples, and in the end we'll do some practice questions. Budget is an annual financial statement showing item-wise estimated receipts and expenditure of the government over the fiscal year, which runs from 1st April to 31st March. Now, the structure of the budget consists of receipts and expenditure. There are two types of receipts, revenue receipts and capital receipts, and two types of expenditure, revenue expenditure and capital expenditure. In this session, we will be discussing in detail only the receipts aspect. So, we'll talk about revenue receipts with examples and capital receipts with examples. Revenue receipts are those receipts which do not create any liability for the government, nor do they reduce the assets of the government. Revenue receipts can be categorized into two: tax revenue and non-tax revenue. Tax revenue, as the name suggests, is the revenue earned by the government through taxes. Now, what is a tax? Tax is a legal compulsory payment imposed by the government. There are two types of taxes: direct taxes, whose burden cannot be shifted onto others. They are to be paid by the persons on whom they are levied. For example, income tax, property tax, wealth tax, profit tax, etc. Indirect taxes, on the other hand, are those taxes whose burden can be shifted onto others. They are levied on the producers, who add them to the market price of their product, thereby shifting the burden onto the consumers. For example, GST, excise duty, custom duties, import duties, etc. A largest part of public revenue in most of the countries is raised through taxes. It's an important source of revenue receipts for the government. Non-tax revenue can be categorized into four: commercial revenue, which is earned from the sale of goods and services by the government, for example, through railways, electricity, tolls, postage, etc. Administrative revenue arises because of the administrative functions of the government. For example, fee like court fee, passport fee, license fee, etc. Forfeitures, fines and penalties charged by the government for disobeying rules and regulations or for violating laws. Escheats are the funds which the government receives from ownership of unclaimed property due to there being no legal heir or beneficiary. The central government gives loans to the state governments and union territories, and they receive an interest on those loans. This interest is also a part of non-tax revenue. Dividends paid to the government form a very significant part of the non-tax revenue. Surplus of RBI and nationalized banks refer to the excess of income over expenditure of these banks, and this surplus is transferred to the Government of India, and it plays a vital role in government's budgetary requirements as well as its fiscal policy. Grants and aid received by the government also comes under non-tax revenue, but is not included in the main components of non-tax revenue because it cannot be estimated. It is not recurrent. Capital receipts are those receipts which either create a liability for the government or reduce the assets of the government. We can categorize capital receipts into 4 categories: market loans, government borrowings, recoveries, and other receipts. Market loans are the loans raised by the government from the public through various instruments like open market operations. Government borrowings includes borrowings of the government from RBI and commercial banks, and also loans taken from the World Bank, International Monetary Fund, and foreign governments. Recoveries of loans from state government and union territories. So the central government gives loans to state governments and union territories, and when the state governments and union territories return the loans to the central government, then those are called recoveries. Other receipts include small savings in the post office saving accounts, Public Provident Fund PPF, which is a Government of India savings and investment scheme with tax-free interest and long-term benefits. And lastly, disinvestment, which is the process of selling of government's equity capital holdings of select public sector units to private individuals. Now let's see the reasons why all these categories are capital receipts. First, market loans are capital receipts because they increase the liabilities of the government. Government borrowings also increase the liabilities of the government. Recoveries lead to reduction in the assets of the government, the financial assets of the government on which they were earning an interest income. Public Provident Fund increases the liabilities of the government, and disinvestment reduces the assets of the government and are therefore a part of capital receipts. We can classify capital receipts into debt creating capital receipts DCRs and non-debt creating capital receipts NDCR. Debt creating capital receipts are the ones which create liabilities for the government and therefore include the market loans raised from the public and all other borrowings from RBI, commercial banks, International Monetary Fund, World Bank, etc. and small savings in the post office saving account and public provident fund. All these create liabilities and are therefore called debt creating capital receipts. Non-debt creating capital receipts are those which reduce the assets of the government. So it will include recoveries of loans from state governments and union territories and disinvestment. Now let's do some practice questions. Identify whether the following are revenue receipts or capital receipts, giving reasons. Let's start. Receipts from railways are revenue receipts, more specifically commercial revenue receipts, because they neither create a liability nor reduce assets of the government. Receipts from fines and penalties are revenue receipts again, but now they are administrative revenue receipts. Reason remains the same, neither create liability nor reduce assets of the government. Public borrowing and market loans are capital receipts because they create liabilities for the government. Disinvestment is also a capital receipt because they reduce the assets of the government. Now pause the video and attempt the rest of the questions, and then I'll share the answers with you. So the answers are on the screen. Kindly pause the video again and check your answers. This brings us to the end of the session on budgetary receipts. Hope you found the session useful. If you have any doubts, please leave them in the comment section below. In case you found the video helpful, remember to press the like button and share it with your friends. Subscribe to the channel for more economics concepts and tutorials.